down 45% and 90% off their recent highs, I'm going to share with you two growth stocks that I think you might regret not buying on the dip. Those two growth stocks are Airbnb, which is down 45% off its high, and Fiverr International, which is down 90% off its highs in 2021. So in this video, I'm going to share with you the reasons why I think these growth stocks are a buy on the dip. So let's begin. Starting with robust revenue growth, each of these companies has done well. Airbnb, starting with Airbnb, growing from a little over 800 million in revenue in 2020 all the way up to 1.9 billion in quarterly revenue. As of its most recent update, it reached a peak of over 2.4 billion, and Airbnb's business is seasonal. So in this upcoming summer quarter, it will again, I believe, eclipse that peak it reached in the summer of 2022. All signs point to that happening. Consumers are unleashing pent-up demand for travel. Overall, worldwide spending on hotels and resorts is still not back to 2019 levels. Let that sink in. We're still not back to 2019 levels. So there is more to recover from the lost spending in hotels and travel and vacation spending. On top of that, Airbnb is gaining market share, so it's got a powerful tailwind behind it, and that's something you're going to want to capitalize on. Fiverr International also increased revenue nicely from less than 25 million in 2019 up to 83 million most in its most recent quarter. Fiverr's business is less seasonal. As you can see, you don't see ups and downs like you do with Airbnb. But Fiverr also is capturing a tailwind, right? Fiverr's website, you can hire people to do specific jobs and specific tasks, which is a lot more convenient if you're a small business owner. Instead of going out and hiring a full-time individual, you might not have confidence that your business is going to need these services for the rest of the year. And so you can hire people for specific projects or for specific groups of projects without making that large commitment to hire a full-time employee, which comes with all kinds of inconveniences. So for that reason, Fiverr International is catching a tailwind that I believe is long term, as well as Airbnb. So both of these companies, revenue growth expected long term. Now, I like to see companies that are growing for them to be profitable, of course, but if they're not profitable, I like to see progress towards profitability, and I get both of that here. Airbnb, explosive operating margin expansion from of course, it crashed during the pandemic when fewer people wanted to travel. But as economies reopened, it's really rebounded strongly, stronger than ever before. Operating profit margin 22.51% and moving higher for Airbnb. Fiverr, not as dramatic a crash and rebound, but still, if we go back to 2019 and draw a line here, from negative 45% operating profit margin to negative 13.9%, moving in the right direction, even though it's still negative. Similarly, if we look at cash flow from operations to sales over the trailing 12 months, this metric looks at a company's ability to generate cash flow, which is sometimes better than its ability to generate profits because businesses have non-cash expenses, primarily depreciation and amortization and stock-based compensation. If you exclude those, which are non-cash expenses, you start to get a better picture of the company's ability to generate cash flow, which you see strong evidence of here with these two growth stocks. Airbnb generating cash flow from operations to sales at 41% and moving higher. Fiverr International at 8.9% and also moving higher. So you get these benefits from both of these stocks in moving upwards and also positive with cash flow from operations to sales. The final reason why I think you might regret not buying these growth stocks on the dip is their reasonable valuation. I showed you all of the positive metrics, all of those things moving in the right direction, the tailwinds for revenue, and you're getting all those benefits with these companies at reasonable valuations. Airbnb trading at a forward price to earnings of 28.5, which is near the lowest it's been going back nearly a year and a half. Fiverr International trading at a forward price to earnings of just 19.29, which is the cheapest this stock has been going back 2.5 years, according to this metric. So you're getting these two excellent growth stocks with very good prospects going forward, and you're getting them at very good valuations because of this big dip, right? 45% and 90% off their highs. So this dip is allowing you to buy these stocks at bargain valuations, which I think you might regret if you don't do it right now. All right, so that's all I've got for this video. Thank you so much for watching. If you like this video, please go ahead and subscribe. I've got a lot more content just like this. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.